You hit a trade. It moves your way. You're up 20% in 30 minutes. Your heart rate spikes higher than when you entered. The candle is green and aggressive, pushing through resistance like it's made of paper. You stare at that unrealized profit number flashing on your screen, enough to pay for groceries this week, maybe a tank of gas. And then something terrible happens. You freeze. The amateur closes out immediately, clicks sell with frantic relief, takes the win, screenshots it, posts it in Discord, tells himself he's disciplined, that nobody ever went broke taking a profit. He feels smart for exactly 4 hours. The professional, he hasn't even touched his mouse. He's leaning back, watching the volume, watching the tape, completely calm, because he knows something you don't. The real money isn't made on the entry, it's made on the ad. Let me show you exactly what this looks like. 2 traders. Same stock. Same entry at $10. Both catch the breakout perfectly. The stock runs to $12 in 45 minutes, a clean 20% move. Trader A, the amateur, sells everything at $12. He's thrilled, made $40 on his $200 position. He texts his friend. He feels safe. He protected his capital. He did everything the YouTube gurus told him to do. Trader B, the professional, is just warming up. He started with $100, risking only 5 on 10 shares. When the stock hit 11 and held for 15 minutes, he added 5 more shares. When it hit 12 with strong volume, he added 2 more. Now he's holding 17 shares with an average price of $10.59. The stock continues to 13, then 14, then 15 by session close. Trader A made $40. Trader B made $75 on a position that started smaller. Same move, same stock, same day. But one understood something the other didn't. The best time to increase your bet is when you're already winning. Here's the brutal truth that social media won't tell you. 92% of retail traders leave the table after one winning position. They scale out. They take profits. They turn a potential 10-bagger into a single base hit. And they wonder why their accounts never grow past 4 figures. They wonder why they've been trading for 3 years and still can't quit their day job. The math is working against you because your psychology is broken. If you always cut winners at 20%, but your stops are at 10%, you need a win rate that's statistically impossible to maintain just to break even. Think about it. Take 10 trades. You're right on 4 of them, a 40% win rate that sounds mediocre. But if you lose $5 on each of your 6 losers and make $60 on each winner, you just made $210. You lost 30 and made 240. You're up with a 40% win rate. That's the power of asymmetry. But most traders flip this upside down. They make $5 on winners and lose 60 on losers. Same win rate, opposite result. They're broke. The same mindset that wants $1,000 from a $100 bet in one shot is the mindset that loses everything in one shot. It's the lottery ticket mentality. It's why you see traders posting massive gains one week and going silent the next. Professionals flip that completely. They start with $100 risking 5 to 10 and only increase size with house money. They don't go big or go home. They go small, survive, then press the advantage when the market finally proves them right. Think of your initial position as reconnaissance, a scout sent ahead of the army. If the scout reports back that the coast is clear, you send in the troops. If the scout gets killed immediately, you're glad you didn't commit the whole battalion. This isn't theory. Jesse Livermore turned $5,000 into $3 million in 1929 using this exact method. Not by catching bottoms, not by diversifying, by loading the boat when he was right. And only when the market confirmed he was right. He would enter small, watch the tape, and if the stock proved itself by holding gains and attracting volume, he would add. Each ad smaller than the last. Each ad only after confirmation. Each ad protected by trailing stops. When that trade moves 20% in your favor, that equity doesn't belong to you yet. It belongs to the market. Most people try to snatch it off the table. The professional uses that equity as a shield. He uses the market's money to finance a larger position. If you opened a store and customers were lining up around the block, Would you close the doors after serving 10 people just to lock in profit? No. You'd extend hours. You'd hire more staff. You'd expand because the trend is in your favor. Your problem isn't that you don't get good entries. You've probably nailed the start of more than one monster move. Your problem is your entire psychology is built around exiting winners, not building them. You're trained to think green, escape. A professional thinks green, evaluate. Is this strong enough to justify more risk? This script is your 1-hour blueprint to making that shift. 4 rules. 4 chapters. By the end, you'll know exactly when to add, how much to risk, and how to lock in 4-figure gains from a single trending move, even starting with just $100. But here's what nobody tells you. Pyramiding isn't about position size. It's about position structure. It's about building your position in a way that survives volatility. The moment you start adding based on hope instead of proof, you've already lost. You see a trade that moves 5% is just noise. A trade that moves 10% is just a spark. We're looking for fire. We're not interested in catching bottoms or selling tops. We're interested in the meat of the move, the middle 60% where the easy money lives. To get there, we need to treat our first entry not as a position, but as a question. You're paying a small premium, your initial risk, to ask the market, is this trend real? Most traders are screaming the answer before the market opens its mouth. They enter and immediately start dreaming of Ferraris. The professional enters assuming he's wrong until price action proves him right. He waits. He watches. He looks for the specific signature of institutional momentum. He's looking for confirmation. Confirmation isn't a feeling. It isn't a hunch. It's a measurable, objective event that tells you buyers are in control and sellers are exhausted. It's the green light that says it's safe to deploy more capital. Without confirmation, adding to a trade is gambling. With confirmation, it's the highest probability action you can take. The first rule, it's not about being right. It's about being right enough to add. And that requires something most traders skip entirely. Confirmation. Not the confirmation you feel in your gut. Not the confirmation from a green candle. Real confirmation. Mathematical confirmation. The kind that separates real trends from fake breakouts. The kind Jesse Livermore waited for before adding a single share. That's what we're covering next. How to confirm the trend. How to know when the market is actually agreeing with you, not just teasing you. Because until you answer that, you're not pyramiding. You're just guessing bigger. Here's where amateurs die. They add to hope, not proof. You enter a breakout. It moves 5% in your favor. Your heart rate spikes. You feel that rush in your chest. You think, this is it. This is the one. So you double your position. Maybe you triple it. For exactly 4 minutes, you feel like a genius. Then the stock does what stocks always do when amateurs get excited. It breathes. It pulls back. That 5% turns into 2%. Then 0. Then -3. Your oversized position hits your stop. You're out. You've just turned a small win into a medium loss. And you sit there, staring at the screen, asking the same tired question. Why does this always happen to me right after I size up? It happens because you're adding to emotion, not evidence. You're adding to your feelings about the trade, not the market's confirmation of the trade. The professional waits for confirmation. Not a hunch, not excitement, not a gut feeling that this time is different. Confirmation. Cold, objective, measurable confirmation that separates real trends from retail traps. Think of the market as a courtroom. Your initial trade is just an accusation. I accuse this stock of going higher. But until the market provides evidence, the witnesses, the volume, the price structure, the professional refuses to commit meaningful capital. The first position is reconnaissance. You're paying a small fee to see the market's cards. Let's make this concrete with numbers that matter. You have a $100 account. The amateur looks at a breakout setup at $10 and thinks in terms of all or nothing. He throws the full 100 at the hot breakout. 10 shares. No plan beyond hope. He's risking his entire account on a single idea. The professional quietly does something completely different. He risks $5 to $10 maximum on what Jesse Livermore called the test position. He enters at $10 with 10 shares, a $100 position, but with his stop at $9.50. His actual risk? $5. 5% of his account. If he's wrong, it stings, but doesn't cripple him. He can be wrong 19 more times and still have money left. But here's what makes this powerful. He's not trying to be right. He's trying to gather information. He's asking the market a question with his $5 tuition payment. The stock runs to $10.50 in 12 minutes. That's a clean 5% move. The amateur would have already added by now, convinced he's caught lightning. The professional hasn't moved. He's watching. He's waiting for the answer to his question. Here's the confirmation rule that changes everything. The stock must hold above $10.25 for the next 15 minutes without giving back more than half the move. Let's break down why this matters. The stock moved from 10 to 10.50. That's a 50-cent move. Half of that move is 25 cents. So the stock needs to hold above 10.25. It can wiggle. It can test. But it cannot close below that halfway mark during your 15-minute observation window. Why 15 minutes specifically? Because in a true trending move, momentum doesn't pause for long, but it does breathe. The first 5 to 10 minutes after a breakout are chaos. Algorithms are executing. Retail traders are panic buying. Stop losses are triggering. Scalpers are taking quick profits. It's pure noise. Weak hands get shaken out in the first 10 minutes. They bought the breakout, saw it stall, got scared, and sold. Strong hands, the institutional money, the smart money, they accumulate during this chaos. They're not chasing. They're layering in size while retail is panicking. By minute 15, the dust settles. You know which side you're on. If the stock is still holding above the halfway point, you're on the right side. If it's already back at your entry or below, you dodged a bullet by not adding. Here's what real confirmation looks like on the tape. The stock hits 10.50 at minute 12. Over the next 15 minutes, you see this: 10.48, 10.42, 10.38, 10.35, 10.32, 10.28, 10.27, 10.29, 10.33, 10.38, 10.42. It dipped to 10.27, just 2 cents above your threshold, but it held. Buyers stepped in. That's confirmation. Compare that to failed confirmation: 10.50, 10.45, 10.38, 10.28, 10.18, 10.12, 10.05. It sliced right through 10.25 without hesitation. No support. No buyers. That's a trap. You exit your test position with a small gain and move on. You just saved yourself from adding into a reversal. Your first trade buys information. Your ads buy profit. Burn that maxim into your brain. Your first trade is tuition. You're paying the market to teach you whether this move is real. Most traders think their first trade should make them rich. That's backwards. Your first trade should keep you small, in size, in risk, in commitment. The goal of the test position is simple. You want the market to prove it's trending before you risk meaningful money. You plan this before you enter, removing emotion from the decision. If price moves plus 5% and holds above the halfway point for 15 minutes, that's my first ad zone. If it fails immediately, I'm out with a small loss. Most traders skip this step because they're terrified of missing the move. They see the stock run from 10 to 10.50 and panic. It's getting away from me. I need to add now before it hits 11. So they add at 10.50 without confirmation. Then the stock pulls back to 10.10 and they're underwater on their entire position. Here's the truth they don't want to hear. The move that runs without you wasn't your trade to begin with. If a stock goes from 10 to 15 without ever giving you a confirmation signal, that trade wasn't designed for your style. It wasn't structured for your risk parameters. Let it go. The move that waits for confirmation, that's the one that pays. That's the one that gives you multiple opportunities to add. That's the one that trends cleanly with pullbacks that respect structure. That's your trade. This is why professionals can pyramid with confidence, while amateurs blow up trying to do the same thing. The professional only adds after the market validates his thesis. The amateur adds because he wants to be right, not because the market proved him right. There's a deep psychological shift here. The amateur's mindset: price is going my way, I need to hit it hard now before it's gone. Fear of missing out drives every decision. He's reacting to price. The professional's mindset: price is going my way. Let's see if it can pass my test. If it does, I'll build. If it fails, I'll leave. Patience and criteria drive every decision. He's making price qualify itself. Same chart, same candles, completely different outcomes. So you've entered your test position at $10 with 10 shares, risking $5. The stock runs to $10.50 and holds above $10.25 for 15 minutes. The volume on selling was light. The bid is stacking up. You have confirmation. The trend is real. Buyers are in control. The market has answered your question with a resounding yes. You're now in the top 8% of traders who actually have a plan for what comes next. You have the green light to add. You have permission from the market itself. But now comes the critical question that separates the wealthy from the bankrupt. How much do you add without gambling your edge away? Position sizing is where pyramiding becomes either a printing press or a death sentence. This is the mathematical crossroads where theory crashes into reality. You can nail the entry. You can confirm the trend perfectly. You can read the tape like Jesse Livermore himself. But if you get the sizing wrong on your ads, you will transform a winning trade into a catastrophe that haunts you for months. The amateur approaches adding with greed as his only calculator. He sees green candles and thinks bigger is better. He starts with 10 shares at $10. The stock moves to 11. He feels smart, so he adds 10 more shares. The stock pushes to 12. Now he's feeling invincible. He adds 20 shares because this is the big one. He's built what looks like a pyramid on paper, but it's actually a death trap. Let's do the math on the amateur's structure. 10 shares at $10 costs $100. 10 shares at 11 costs $110. 20 shares at 12 costs $240. His total position is 40 shares costing $450. His average price is $11.25. The stock is trading at 12. He's up 75 cents per share on average. $30 in paper profit. He screenshots it. He feels like a genius. Then the stock does what stocks always do in the middle of trends. It breathes. It pulls back to $11. Watch the amateur's world collapse. His average price is $11.25. The market is at 11. He's now underwater on 20 of his 40 shares. His $30 profit just became a $10 loss. The pullback continues to $10.75. Now he's losing on 35 of his 40 shares. His nervous system can't handle it. He panic sells everything for a $40 loss. The stock bounces at $10.50 and runs to 15 over the next 2 hours. He watches from the sidelines, swearing pyramiding doesn't work. But the strategy isn't broken. His structure was upside down. The professional does the exact opposite. He builds what Jesse Livermore called the inverted pyramid, wide at the bottom, narrow at the top. Heaviest size at the safest price, lightest size at the riskiest price. This isn't just clever terminology. It's mathematical protection against the inevitable volatility that comes with every trending move. Here's the step-by-step mathematics that changes everything. Your test position is 10 shares at $10. That's a $100 position, risking $5 with your stop at $9.50. The stock moves to 11 and passes your confirmation protocol. Time to add. But you don't add 10 shares. You add 5, half the size of your base layer. Let's calculate your new average price. You own 10 shares at $10. That's $100 in cost. You buy 5 shares at 11. That's $55 in additional cost. Total cost is $155. Total shares is 15. Average price is $155 divided by 15, which equals $10.33. The stock is trading at 11. Your average is $10.33. You have a 67-cent cushion per share. You're profitable on every single share you own. The trend continues with clean structure and rising volume. The stock moves to $12 and confirms again. You add once more, but you have the size again. You add 3 shares at $12. Now let's recalculate. Previous cost was $155. Adding 3 shares at 12 costs 36 more. Total cost is $191. Total shares is 18. Average price is 191 divided by 18, which equals $10.61. Notice what just happened. The stock is at $12. Your average cost is $10.61. You have a massive $1.39 cushion between current price and your average cost. You're up about $25 on the entire position. Now the inevitable happens. The stock pulls back from $12 to $11, a completely normal 50% retracement of the last leg up. Remember the amateur? He was underwater at 11. Your average is $10.61. Even with a full dollar pullback, you're still up 39 cents per share. $7 in profit. You can sit calmly while amateurs panic sell their positions to you. You've built a fortress, not a house of cards. Your position can withstand the natural volatility of a trending market. You increase your size, not your risk. That's the maxim that separates professionals from gamblers. Most traders think adding to a position automatically means risking more money. That's backwards thinking. If you structure it correctly, each add actually decreases your vulnerability. Here's the crucial mechanism that makes this bulletproof. You never add the second layer until the first layer is financed. This word matters. Financed means the market has paid you enough unrealized profit to cover your original risk. When the stock hits 11 and you're ready to add 5 shares, you first move your stop on the original 10 shares from $9.50 to $10.50. What did you just accomplish? You locked in 50 cents profit per share on those 10 shares, $5 total. Your original $5 risk is now completely eliminated. You cannot lose money on this trade anymore. Now you add 5 shares at 11 with the same stop at $10.50. If the stock reverses and hits your stop, you make $5 on the first 10 shares and lose about $2.50 on the 5 shares added at 11. Net result? $2.50 profit minimum. You're trading with house money. Your original capital is protected. This psychological shift is enormous. You're no longer risking your rent money on every price wiggle. You're pressing an advantage with the market's own profits. You can think clearly. You can respect your stops. You can let winners run because you're not terrified of giving back your own cash. If the stock runs to $15, your 18 shares are worth $270. You started this campaign with $100. That's a $170 gain, a 170% return on your account from a stock that moved only 50%. You didn't catch the bottom. You didn't predict the top. You built a position using disciplined mathematics and the market's own momentum. This is how small accounts become large accounts. Not through home run swings on single positions, but by pressing advantages when the market proves you right. The inverted pyramid forces you to earn your size. You only get to meaningful size when the market validates your thesis repeatedly. But here's the trap that catches even disciplined traders who master this structure. When you're sitting on a mountain of paper profit, when you've nailed 3 adds perfectly, greed starts whispering, "Why stop here? Add one more layer. The stock is going to the moon." That voice has destroyed more trading accounts than bad entries ever will. You can't just keep adding forever. There's a specific limit, a hard rule that tells you when building mode ends and protection mode begins. And it's not when you think. The 4th add is where discipline dies. That's the next rule. That's what we're covering next. Greed whispers, "Add one more time." You know that voice. It's seductive, rational. It sounds like opportunity knocking. You've nailed the entry perfectly. You've confirmed the trend 3 separate times. You've built your position like a professional, each add financed with the market's own money. Your equity curve is finally bending upward the way you always imagined it would. You stare at your unrealized profit, and your brain does something dangerous. It starts doing fantasy math. If I just add a little more size here, and this keeps running, I could double this gain. I could flip this account in one trade. The amateur listens. He can't help himself. He's already added 3 times. The stock is flying. Each candle closes green and aggressive. Social media is buzzing about the breakout. Volume is surging. His paper profit is larger than his last 3 paychecks combined. So he adds a 4th layer at $13.50. Then the stock hits 14, and he adds 10 more shares. His discipline evaporates in the heat of euphoria. Let's watch his structure collapse in real time. He started with 10 shares at $10, added 5 at 11, added 3 at 12, then lost his mind. He added 5 more at $13.50, then 10 at 14. Total shares, 33. Total cost, 100 plus 55 plus 36 plus 67.50 plus 140 equals 498.50. Average price, $15.11. The stock is at 14. He's underwater on his average cost before the pullback even starts. His entire position is now a house of cards built upside down, heavy at the top where the air is thin. Then the market does something completely normal. It pulls back 5%. 14 drops to 13.30 in 8 minutes. That's not a crash. That's not a reversal. That's just a trend taking a breath. But for him, it's a catastrophe. His average price is $15.11. The market is at $13.30. He's red on 28 of his 33 shares. His stomach turns. The voice that told him to add is now screaming at him to exit. He panic sells everything at $13.25. The stock bounces at 13 and runs to 18 over the next day. He watches from the sidelines, psychologically destroyed, swearing he'll never pyramid again. But pyramiding isn't broken. His structure was upside down. The professional knows the rule that would have saved him. 3 ads maximum. Then you ride. This isn't arbitrary. This isn't superstition. This is mathematics meeting psychology at the exact point where most traders self-destruct. 3 ads is the perfect balance between capturing meaningful size and maintaining a structure that can survive inevitable volatility. It's the sweet spot, where you've confirmed the trend enough times to trust it, but haven't built a position so large that normal market breathing destroys you. Why 3 specifically? Because by the 3rd ad, you've captured the meat of the move. Your position is large enough to generate account-changing returns, but your average price is still low enough to withstand pullbacks. You've forced the market to prove your thesis 3 separate times. You're not guessing anymore. You're executing a mathematically sound sequence. Here's what 3 ads looks like in our blueprint. Entry at $10 with 10 shares, $100 invested. First ad at $11 with 5 shares, $55 more. Second ad at $12 with 2 shares, $24 more. Third ad at $13 with 1 share, $13 more. Total cost, $192. Total shares, 18. Average price, $10.67. The stock is at 13. You're up $2.33 per share on your average cost. $42 in total profit. You're up 21% on your average cost with a massive cushion for volatility. Your position is complete. Now you stop adding. Put your hands under your thighs. Step away from the buy button. You shift from construction mode to protection mode. You trail your stop. You let the trend do the work. But here's what happens next, and this is where most pyramiding attempts die. The natural reaction. The stock drops from $13 to $11.75 in 15 minutes. A $1.25 drop. Almost 10% from the high. 30% of your paper profit just evaporated in a quarter hour. Your $42 gain is now $20. This is the moment of truth. This is where most traders panic sell, terrified of losing what they just made. The 4th ad is where discipline dies. That maxim needs to be burned into your brain. Not the 3rd ad, not the 5th, the 4th. Because by the time you're considering a 4th ad, you're no longer following mathematics. You're following emotion. You're no longer building structure. You're gambling on continuation. The 4th ad transforms a fortress into a house of cards. The professional expects the natural reaction. In fact, he needs it. Every extended move has to breathe. Weak hands have to get shaken out. Profit takers have to exit. Algorithms have to rebalance. This isn't a sign the trend is over. It's proof the trend is healthy enough to continue. When price pulls back from 13 to 11.75, the professional isn't watching the price action. He's watching the volume signature. Is the selling heavy and violent, with massive red volume bars that dwarf the green ones that built the move? That's distribution. That's institutions heading for the exits. That's a trend reversal in progress. Or is volume drying up as price drops? Are the red candles getting progressively smaller with declining volume? The first candle down from 13 to 1280 had moderate volume, some natural profit taking. The second candle to 1250 had less volume. The third candle to 1220 had even less. By the time it hits 1175, volume is a whisper. The selling is exhausted. If the stock drifts lower on light volume, the big players aren't selling. They're resting. They're consolidating gains before the next leg higher. The bid is stacking up at 1170. Buyers are stepping in at what they see as a discount. This is a healthy pullback, not a reversal. Your average cost is $10.67. Even at 1175, you're still up $1.08 per share. $19 in profit. You're protected by your structure. Your inverted pyramid is intact. Your stop should be trailing under structure, not emotions. Not under the current candle where fear lives. Not based on how much paper profit you're willing to give back. Under the last significant higher low. Under the breakout level. Under the level that, if broken with conviction, would invalidate the entire trend structure. In this case, your original first ad level was $11. As long as the stock holds above 1050 to 11, the zone where you first confirmed this was a real trend, your pyramid is intact. If it breaks 1050 with heavy volume and conviction, the trend structure is broken. Exit everything. But until then, you sit. Jesse Livermore captured this perfectly. It never was my thinking that made the big money for me. It was always my sitting. The sitting is harder than the buying. The sitting requires more discipline than the entry. The sitting is where fortunes are made and lost. The stock bounces at 1175. Volume picks up on the bounce, buyers stepping in. It drifts back to 12, then 1240, then 13. Your 18 shares are back in the black, with room to run. Then 14, then 15. Your 18 shares at an average of 1067 are now worth $270. You're up $78, a 78% gain on your initial $100 capital from a stock that moved 50%. You captured more than the stock's move because you built the position correctly. You started small. You added with confirmation. You capped yourself at 3 layers before the structure became dangerous. You survived the natural reaction that shook out the weak hands. But you're not done yet. The trend could continue to 20. It could reverse tomorrow. You need a mechanical system to lock in these hard-earned gains as price climbs higher. You need a way to ensure that no matter what happens next, you never turn this winner into a loser. Now comes the final rule, the one that locks in everything you've built and transforms this campaign from a paper profit into permanent capital. You've built the pyramid. You've survived the reaction. You're sitting on real money now, not paper dreams, but actual account-changing profit. Your 18 shares with an average cost of $10.67 are worth $270 at 15. You're up $78 from a $100 start. That's a 78% gain, and the trend shows no signs of stopping. This is the moment every trader dreams about. You're finally on the right side of a monster move. But here's the brutal truth. This is also where most traders quietly destroy themselves. Not through bad entries. Not through poor confirmation. Through catastrophic exit management. The amateur thinks the hard part is over. He's built the position correctly, survived the pullbacks, and now he's counting unrealized profits. So he does something that sounds smart, but is actually suicidal. He leaves his original stop at $9.50. I'm giving the trade room to work, he tells himself. I don't want to get shaken out by noise. Watch his world collapse in slow motion. The stock runs from 15 to 16, then pulls back to 14. Normal breathing. He's still up. Then 1350. Still comfortable. Then 1275. His $78 gain shrinks to 37. His hands start shaking. $12. $25 left. $11.50. $15 remaining. His nervous system is screaming at him to exit, but his stop at $9.50 hasn't been touched. Then the stock tests $11. His unrealized gain of $78 is now $7. One more red candle to $10.75, and he panic sells everything. His result? maybe a $5 profit after commissions. He just gave back a $73 gain for a scratch. He turned a career-defining winner into a psychological disaster that will haunt him for months. The stock bounces at 10.50 and runs to 20 over the next week. He watches from the sidelines, convinced the market is rigged against him. But the market isn't rigged. His stop management was broken. The professional trails his stop below each ad level. He treats every layer of his pyramid as a new floor in a building. Once you build the second floor, you don't fall back to the basement. You fall to the first floor. Each ad level becomes both a confirmation point and a protection zone. Here's the mechanical system that changes everything. You enter at $10 with your stop at $9.50. When you add 5 shares at $11, you immediately move your stop on all 15 shares to $10.50, below the first ad level. What just happened? You locked in 50 cents profit per share on your original 10 shares, $5 guaranteed. Your original risk is eliminated. You cannot lose money on this trade anymore. The stock moves to 12, and you add 2 more shares. The moment that order fills, you move your stop on all 17 shares to $11.50. Let's calculate your protection. Your 10 shares bought at 10 would exit at $11.50 for $1.50 profit each. $15 locked. Your 5 shares bought at 11 would exit at $11.50 for 50 cents profit each. $2.50 locked. Your 2 shares bought at 12 would exit at $11.50 for a 50-cent loss each, $1 loss. Net guaranteed result, $16.50 profit minimum. You've locked in profit on the majority of your position while still participating in the upside. This is the mathematical magic of trailing stops. You're playing with house money while the house keeps raising the floor. The stock moves to 13, and you add your final share. You push your stop to $12.50 on all 18 shares. Now every single share you own is profitable if stopped. Your average cost is $10.67. Your stop is $12.50. That's $1.83 cushion per share. $33 in guaranteed profit. That's your worst-case scenario, a 33% return on your original $100 capital. Now the inevitable happens. The stock pulls back from 15 to $13.50. You're calm because your stop is at $12.50. $13.25. Still in. $13. Still protected. $12.75. Your hands are steady because you know the math. Then $12.55. Still safe. $12.52. The selling accelerates. $12.48. You're stopped out on all 18 shares at $12.50. Your result? 18 shares times $12.50 equals $225 out. Minus your total cost of $192. Profit, $33. That's a 17% gain captured from a stock that ultimately failed to hold its highs. You didn't catch the top, but you captured the meat with maximum size and 0 risk. Lock profit as you climb. Never let a winner turn into a loser. This maxim separates professionals from amateurs more than any other concept in trading. The amateur holds winners hoping they become bigger winners, then watches them turn into losers. The professional locks incremental profit at each confirmation level, ensuring that even failed trends pay him. This is why professionals can pyramid with confidence, while amateurs blow up attempting the same strategy. The professional structure gets stronger as it grows. Each ad is financed by previous gains. Each stop level protects accumulated profit. The amateur's structure gets weaker as it grows, with his entire gain exposed to a single reversal. Here's your complete blueprint. 4 rules that turn $100 accounts into 4-figure accounts. First, confirm the trend. 15 minutes above half the move. No emotional ads. Your first trade buys information, not profit. Second, have your size on every ad. Build an inverted pyramid. 10 shares, then 5, then 2, then 1. Wide at the bottom where it's safe, narrow at the top where it's dangerous. Third, stop at 3 ads maximum. The 4th ad is where discipline dies and structures collapse. Survive the natural reaction instead of being killed by it. Fourth, trail your stops and lock the pyramid. Move your stop below each ad level. $10.50 after the first ad, $11.50 after the second, 12.50 after the third. Lock profit as you climb. Do this once correctly, and you'll turn 100 into 180. That's an 80% gain from disciplined execution. Do it twice in a week on separate trending setups, you're at 324. Find one clean extended trend and execute all 4 rules flawlessly. 100 becomes 500, 800, even 1,000 over a series of campaigns. The mathematics of compounding becomes explosive when you eliminate large losses. When your worst trades are small scratches and your best trades are fully loaded pyramids, your account has no choice but to grow. This isn't theory. This is the mathematical reality of asymmetric risk management. The market pays patience. It pays discipline. It pays the trader who knows when to add, when to stop adding, and when to walk away with his pockets full. It doesn't pay the smartest analyst or the fastest scalper. It pays the one who can follow a simple 4-step process without deviation. You didn't turn 100 into 1,000 by gambling on earnings reports or chasing momentum stocks. You didn't find a magic indicator or join a pump group. You did it by building, one confirmed ad at a time, with the market's own money, protecting your original stake every step of the way. You started this hour as a trader who freezes when positions go green, who takes small profits and large losses, who wonders why professionals seem to play a different game. Now you have the rules to that game. You have the structure. You have the mathematics. You have the psychology. The only thing left is execution. The next time you see a clean breakout, don't throw your whole account at it. Send out a scout with your test position. Wait for confirmation. If the trend proves itself, build your pyramid layer by layer. If it fails, take your small loss and wait for the next one. The market is endless. The opportunities are infinite. But your capital is finite. Protect it. Grow it. Respect it. The blueprint is complete. Now go build your pyramid